your head around. So I'm going to show you the challenge here. You can read all this later. We're just going to look at 15-minute charts. This was an old chart with the bonds, and all I wanted to show you here is the pit session. All right, so I actually start my session hours at 7 a.m. Central Time, and in truth, it really doesn't matter if you start at 7 or 7:30 or even 8 or 8:30 for the S&Ps. This is Central Time. But the idea is that it's the U.S. opening, the New York traders are at their desk, the hedge funds up in Boston, or everybody's there awake playing the game. And this is where we go back to those concepts of open drive, open test reject, open rotate, so forth and so forth. So when you get a gap, okay, even if it's just in the pit session, that affords itself great opportunity. And it really doesn't matter what the market is. It really doesn't matter if it's crude or if it's gold or the euro currency or something. For some reason, everybody sits down, and when we did our modeling, we found that the highs and lows for the day for the US session were made most often, okay, if I had to pick one data point, in the first 15 minutes off the opening. Now, of course, not all the time, you know, but if there was going to be one time period where that was, you know, the high frequency of the high or low being made for the day, it was going to be in that first session. Okay, so obviously you can see the gaps that we had, and we didn't fill the gap. Okay, and then of course you trend. So the longer a gap remains unfilled, the greater the edge there. And this gap in trend, I think, is very difficult for people to deal with. So I'm going to just show you one or two little tools, and you can see you get the big gap and trend, and then what happens? You get gap, rotate, gap, rotate. So this would be your you know, your basic auction theory, normal market rotation, consolidation type of thing. And the lovely thing is that you can see this law of alternation. If you've had 2 days of extreme trendiness, then we can expect a day where we might get a little bit more rotation around that early, as what we could call the initial balance, okay, the early trading period, and so forth. So this is something, I'm just giving you stuff that you can study going into the next year. And I wanted to show you now crude. I used the 7 a.m. Central Time, which is a little bit misleading because technically the pit session for crude doesn't open, or didn't open, since there is no longer any pit there, till an hour or so later. But it's still that same concept. Each of these circles here is the first 15 minutes of the day, followed by a little bit of trading. Okay, so you could say it's the first hour. If you want to start at 8 a.m. Central Time, it doesn't matter. 8:15 Central Time, it doesn't matter. But I wanted you to see the feeling of what happens when we start to get these big bars up or down. And maybe one out of every 5 or 6 days tends to be that way. And as a trader, you're like, you know, you're either on board or you're not, or you're caught flat-footed. And how do you deal with this, especially in these S&Ps where it's like open goosing and then the whole moves over in the first 30 minutes, right? Or else it happened overnight. How do you deal with that? We don't have the little continuation patterns that we used to have. And the only pearly words of wisdom I can give you are, A, you can always go down to a 1 or 2 minute chart for that first little flag. You will get a pause. You tend to get one little pause to digest, and that's it. So you better be prepared and awake and have had your coffee already, you know, once the market's open. And for me, it's like a period of extreme concentration once that market opens. You know, I don't want to be talking or anything like that. I want to be ready there to put on the trade. The second thing is that there are many schools out there which talk about putting the buy stop or sell stop above the first 1 minute bar, the first 5 minute bar, the first 15 minute bar. And that's going to be a matter of personal preference, because you can start to get a little bit more noise there. And you have to be particularly adept at recognizing when you are having that increase in volume, because you're going to get chopped up. You see here, the majority of the time we're opening and chop, opening and chop, opening and chop. This is crude, okay? I'm talking about these key areas where obviously here we had a breakdown. This was a 3-bar consolidation pattern. So there's some other things going on here that the daily work would have told us that there was potential for this. Okay, but I just wanted to go down to the basics. Here's a little trick. Okay, here's a little trick that a friend came up with. Okay, that now is going to help you understand that you can just buy or sell at the market. And that is when you see this particularly big bar here, right? And same thing, big bar up here. He calls these a spike and channel, all right? So you've got the spike, the big bar, and then you start to channel here. And it's almost like a perfect measured move. So if I see this big bar up and I say to myself, it's the spike and channel play. Now I don't feel so badly like if I'm late to the game and I'm entering here, okay, because I'm thinking I've got at least the measured move balance of this particular swing. So here, if I'm saying, it's the spike, and now I might start to channel. Well, in this case, I mean, it gave you so much more. And I'm only looking at a 5 or 15-minute chart as an example for you with the S&Ps. There are a lot of other ingredients that can go into our daily preparation of a game plan. Obviously, this is approaching this with no preparation, no game plan, and I don't advise that. But here's another case on gold where we had the gap and we didn't trade into that gap at all. This is off of our 7 a.m. reading. We actually gapped above the previous day's high, so you left this island down there. And if you can say to yourself, aha, you know, here's the spike up, and now let's see if we can channel in a measured move type of fashion. Conceptually, that may help you. Same thing here when we blasted off and we had these big impulse bars. You say that's the spike, and now let's see if we can channel a measured move amount, okay? So it might draw you into the action a little bit more. You can see if that works for you or not. I'm giving you ideas for you to study and play with. Some things might resonate with some people and other things not. Obviously, the bigger the bar, the better the supply-demand imbalance, and that's sort of a given. So these cases here with the NASDAQ, all right, you have that big gap. You aren't able to get on board perhaps unless you were looking at a 1 or a 2 or a little flag thing in that first period of markup, but all's not lost. You can say to yourself, okay, I may not get the little continuation patterns that I was used to 20 years ago, but I know that the higher prices are yet to come, you see. And these are very urgent moves, and there's a lot of opportunity there, but it's it blindsides a lot of people. And so these concepts, back to that Dalton mind over market stuff of the open drives. This would be cases of the open drive, open test reject. This was a great example down here at the bottom where we gapped down, we opened and we tested lower and rejected that with the sharp candlestick tail. So get these little things running in your head. Open, test, reject, open, drive, open, rotate. What was today? We opened and we basically rotated. Why? Because we were right at this previous level and it was a resistance level and it was kind of a home and a high volume node or whatever semantics you choose to describe the price action with. But it wasn't unexpected that the S&Ps sort of stopped where they did into that pocket area, right? You see how all this stuff starts to tie in. I just want to say a word on statistical modeling, because my very first point of this webinar was to point out that you have to have an edge in your trading program. You need to be able to answer to me, what is your edge? What do you think your edge is? Why do you think that you can beat people like me? Why do you think you can beat Mr. Market? What is your edge out there, okay? Some people are exceptionally good at spatial relationships, like that Auntie. They're very good at reading charts. They're very good at understanding that staying out of the noise and waiting for that impulse and stuff. So think about like the architects and the landscape designers and people that can visualize things in 3D. They might be very good at charts. Other people are exceptionally good at processing statistics. And this is where I get a lot of my confidence. Okay, I'm going to show you just one thing, but I've done so much work on this already that's out there I'm not going to belabor it today. The point is that you can ask questions and model anything. So this was something that I put out there the other day, you know, on Twitter, because I saw that the S&Ps were going to break and go for that gap area, and I was thinking, well, this is a slam dunk that we're just going to go down and fill this gap, right? And sure enough, we did. And at the time, the Russell looked like it was going to break down too. And I said at the time, well, but I've also got one model that's going to initiate long on the close. Okay, so that would have been initiating a long on the close here, and then it exits when you get back above to the 5 SMA. And that's the thing you've got to understand about modeling, is it is not a system, nor is it a mechanical system, although you can run baskets of these mechanical systems in parallel. All right, but this is why it's so important to take one data point at a time. So we also had this 3-bar breakout pattern here, right? You can see the 3-bar consolidation here and the 3-bar consolidation here. And this is where I also had a lot of questions from people. How do I initiate on these 3-bar breakout patterns? And that is where, for me, it was extremely useful in trading volatility breakout system. It gave me a fixed ATR variable, even if we gapped up through it, by which the system would be long or short. And of course, you can initiate earlier if you choose. Okay, so in this particular case, the Russell broke down with enough range expansion, as did the S&P, so the volatility breakout systems went short, which simply said that if there's range expansion, there's pretty good odds that we will trade lower the next day. That's all it does. It's like, you know, 68% chance we will trade higher or lower. And that's a small edge. It's not going to be 100%. It's just a small edge. So in this particular case, you know, we did trade lower the next day. So one system could have been short. It gets its objective on the short side. The other model could be long. Models don't have stops. That's what you've got to understand, okay? 5 SMA trades, you know, all these types of works that I put out there on YouTube, which are totally valid for giving you confidence when you are seeing your model work in the direction that, you know, that you're trading, right? Okay, that gives you the confidence to go in and trade on bigger size or so forth. You can say, oh yes, the volatility breakout system's short, you know, blah, blah, blah. I'm going to whale on this thing, and then I'm going to look to cover the next day's opening. But this system, the pinball buy, says we should still go up and trade back above that 5 SMA. And in this particular case, it was only because we pulled so far away from that 5 SMA. That's what gives the pinball 2 type of trade. So it wasn't that it was that we were so many days up or below the 5-period simple moving average, blah, 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 blah. Okay. So you can see here we had the 2 bars pull away, and the first bar that closed below, I didn't think we quite closed below there. The model would have said go long and exit on the first close back above, and it's just a model. That's all it is. So let's just look at 2 other occurrences here where we have this 3-bar triangle pattern where we can get range expansion. And in fact, we did get range expansion here. And in fact, the volatility breakout system would have gone short, but if you had held that trade overnight, it would have gotten stopped out. You see? I just got really blurry here. I don't know why. Did you see that, Kyle? I think it's the darkness. I think it's telling me that the seminar is time to come to an end here, okay? But the point I want to say is that all of these things are statistically driven. I've got a universe of these statistical trades. What we did here is we had the widest range of the last 7 bars to the downside, and we took that out the next day to the upside. So that's a wide range reversal buy, which tells me there's still continuation to the upside once that's happened. And that is the point about when we are trading in the marketplace, about evaluating each data point one at a time. So it doesn't necessarily mean that the market's got a major top in place and we're going to fall out of bed if we hold the pocket area, which we did in here. We held the pocket area and left a little bit of a tail, and then we tried to come back up today, and we just touched that 5 SMA. We did not close back above it. So that's the difference between models and mechanical systems. Some people are very statistically oriented. I highly encourage it at some point in your career. If you've only been trading for 2 or 3 years, it is not a necessary ingredient, okay? But for me, it just proves to me I've got a little bit more of an edge. Now, I've put all these models out there for free at some point, sometime, somewhere, or in some, you know, webinar or money show class or annual workshop or something that I did at one point. And I promise it is going to mean nothing to you. I don't mind disclosing things. You need to take that information and you need to say, oh, volatility breakout system, let me see, how does this test out? How can I tweak these variables? What if I just exited at the end of the day? What if I just initiated on the breakout point during the day, which is an average true range function? And it could be the average true range of 1 day or 2 days, a percentage of that. Toby Crabell used to do it off of the opening price. Larry Williams did a lot of his systems off the opening price. Bob Buran did his range expansion function off of the closing price. So you see there are a million variations on this that you can do. And all of them are going to have some type of statistical edge. But you need to do your own modeling and understand that they are very noisy systems, and they do have drawdowns, and they can be in a drawdown period for 2 to 3 years. I'm going to let you read this later because I am going to give everybody these charts. But I just had to emphasize that models do not have the risk management functions, okay? Just keep that in mind. They are not systems. And you can have one model that's long and another model that's short at the same time. And both can win, all right? That's the way it works. So the short-term modeling, I do the modeling with the big technical daily work, but I also have so many little fun trades that I like to do. And this is my repertoire that I've built up. And I share this with you because I want you to find your own things and look forward to building your own little library of observations over the year 2020. I want you to have your own little notebook. I want you to give them funny little cutesy names. The burning dog is when we gap up and we trade into the gap 4 points. But if we don't trade into that gap 4 points by noon time, then we've got greater odds of making a higher high in the afternoon. It's just it's a pretty robust little concept. So the other day, my assistant and I were joking around because we were trading this Russell, which I normally hate trading, but we're like, well, this is going to be the burning ferret trade, right? Because a friend put in a little thing in Skype of this ferret flip-flopping around and just being totally erratic, which the Russell can be off the opening price, totally erratic. So we've got the burning ferret trade now. And the crude report, you know, our little nuances around there. The rat trade is a trade that we did like 20 years ago. That's the last continuation pattern before you go into the last hour. Just little fun things. This is what makes the market fun. This is why I'm still here. You know, it's really fun. So remember, one data point at a time. Please get rid of this long-term forecasting. Please forget about like saying if we're in a bull or bear market or where this market's going to go to. It's totally irrelevant to your ability to make a living. All right. You don't want your ego to get involved in those types of things, and you don't want to pigeonhole yourself. You want to stay purely technical and one day at a time. That's what I like about Dalton's book, The Mind Over Markets, or the market profile stuff, or Taylor, or even looking at the 120 or 240 minute charts. It's giving me one day at a time, and then I will analyze how did we trade in reaction to that. Now this is just a bunch of junk. This was from a previous seminar. It's just nonsense stuff. I just wanted to show you how ridiculously erratic the market can be as well, that you go from this noise to these extreme trends to back down to this noise. Anytime, okay, here's a tip. Anytime you see this horrific, ridiculous trend with this horrific trap like that, such as we had in this copper market here, the odds are that we do this price equals time, which was put out there also by Gann, drawing his 90% trend line that with that much movement, it's going to take a long time to digest that and for the market to come back into balance. Okay, so these are market profile or auction theory types of concepts coming back into balance. And you can see how sucky this little market has been for the last 5 months. And then lastly, too, the outliers. Understand that you know, that's the problem with time series data. You know, we would like to find equations. We would like to find, to solve for a variable. That's how we were taught in school with math classes and so forth, you know. And a lot of the questions that I get directed towards me are along this lines of wanting to find some type of linear way to approach the markets without really understanding these fat tails or this uneven distribution in the time series data. And here we had a ginormous short squeeze in that natural gas by those that were short in the derivatives markets, and we totally squeezed them out. And the first instinct is, after we start to pull back, you're thinking, oh, I'm looking for the flag, I'm looking for the flag, I'm looking for the flag, without recognizing that you had the dramatic shift in momentum. So that's why I like the 2-period rate of change or short-term momentum tools. You could use a 5-period rate of change. It really doesn't matter, because I'm waiting for those to signal the shift in the short-term momentum, and then the longer-term momentum will follow. It's a study. It's a lifelong study. I want you to understand that it's not like you just get it in 2 days, but I want you to enjoy the process and have fun following these things. You know, every day I see new patterns, new ways of behavior in the market. This V spike, this is when you get these unique opportunities, when you go to these types of extremes, okay, and there's unusual volatility. The reason why this is so difficult for people to understand is because the frequency of occurrence. I mean, how many times have you seen that on a daily chart, you know? Probably maybe once a decade. You know, it just doesn't happen that often. I mean, Trump got elected and he had something sort of similar, but not quite so dramatic like we did there. So that's what makes it challenging. And one last thing, okay, so I can develop a perfect indicator for you, a perfect little system. And these arrows that point here is a mechanical system. Now, it looks pretty damn good, right? You know, I mean, okay, so this one wasn't quite so good, but I had a great buy there. I might have gotten stopped out there. This one was kind of marginal. We just went down one day, but this was a great buy. This was a great sell. This one led to a little reaction down. This buy, right? You know, all this stuff looks great in hindsight. And you know what? I'm going to sell you this course, this indicator, for $5,000. Okay, and you can see that this year it made $10,000 per trade over on 5 contracts over the course of the year. You know, and I've got a bridge for you too. But wait, there's more. See, it actually worked on another market here, and it worked in another time frame. Right? It's not so bad. But you can see also that we'll hit periods where the data is totally not well behaved. And of course, this was a good trade here, but you see what happens. You're going to find something and they're going to change the lock. You find the key and they change the lock. It's not always as perfect. And so my parting words, I got like 1 or 2 more slides, and then I promise I'm going to answer your questions. You must have an edge. What is your edge? Okay, if it's not from experience, if you haven't built up that experience yet, your edge is going to come from preparation. Your edge is going to come from concentration and eliminating distractions. You see, so you have to say, why do I have an edge over my fellow trader sitting you know, in the next state? Okay, why? What is my edge? If you don't have it from experience, it's got to come from preparation, and it's got to come from concentration. You must have a program. Okay, I'm not a jack of all trades. I can't do X number of markets and X number of things. And I love stocks, and I can't fit them into my program. It's just too much activity for me. I got fabulous stock systems and stuff. You know, I'm a one-trick pony when it comes to this. I do my daily plan every day. Be an independent thinker. This was Gann. I think that most people, it's okay if you see what other people are doing, you know, or you do Jim Dalton's course and he tells you things to look for, anomalies, or a workshop or something like that. But Jim's not right all the time. He doesn't even trade futures. You know, he only trades options. So it's a totally different game. So, you know, his thinking works for him. You take the things that you learn from a person like that and adapt them for your own style, okay? You must be an independent thinker and then take the things that you learn and adapt them for yourself. You know, the market conditions are constantly changing. Sometimes they're good. I mean, sometimes we have fabulous volatility and, you know, you're like, why did I go on vacation those 2 weeks, you know? But other times they're just horrible. They're very choppy, they're light volume, they're consolidation, there's not a good strong driver out in the marketplace, and things can change on a dime. I thought this quote was particularly interesting. This was from, once again, Kenneth Grant. A trader will spend most of your time in a drawdown. What does that mean? Okay. It means that you're not going to make equity highs day after day after day after day. You might be like 3 steps forward, 2 steps back, and then it might take you another 3 days to make new equity highs, you know. And of course, he's dealing with more institutional type of clients, or, you know, funds where they do have longer drawdown periods, hopefully, than an individual retail trader. But I've spent a good part of my career in a drawdown. What's important is how long does it take before your next new equity high? Okay, so that's what they call the peak to valley period. You know, how much time do you spend if you have a loss or hit a little pocket of adverse trades, or the environment doesn't favor your system? How long is it until you make back that loss and then make a new equity high? But the majority of their traders, professional traders, are in a drawdown more often than not. So what do we do about that? We bury ourselves in the process, okay? You have to believe in your edge, and keep in mind that 10% of your trades are going to really be where your majority of your profits come from, and the rest are like, this small win canceled out this small loss, you know, this was a scratch, this was chop noise, but really it's going to be 10% of your trades that make the meat of your bottom line. And lastly, the best professional athletes, the highest paid athletes out there, the ones that are making $40 million a year, are a slave to the statistics, all right? They're having their batting averages tracked by everybody out there, and the managers and the agents and so forth and so forth. And you don't think that they don't feel those statistics all the time? Of course. But they don't think about them. They're engaged in their process. They're thinking about their form. They're thinking about their emotion. Same thing with the tennis player, okay? So that's my book. I didn't do this as a sales pitch. That actually just happened to be on there. That's on my website. But if you read that, you'll see how many losses I've made back, as long as and other pearly words of wisdom. Okay, so I've got time for questions, and I emailed you guys as many questions back as I could, okay? So I'm just going to start here, and that is the best way to become better just to have X amount of losses over learning new tricks and techniques? Remember, you want to start with one thing and learn to do it well first. You need that one foundation trade. Josh Waitzkin, however you pronounce his last name, The Art of Learning. Learn to do one thing really, really well first, and then you can build on that. So it's not the number of trades that you make, it's what you can do consistently well. And if you get just one thing that you can do consistently well, the way that you make the big money is then going from 1 contract to 2 contracts to 5 contracts to 10 contracts, all doing the same thing. It's not adding all these strategies and adding all these things to your arsenal, although that's part of the process and that's fun. But you have to get that one foundation trade before you start to clutter your mind. What do you think about going short for a big swing short? Okay, the other thing that I've learned is that I never know where those big, huge wins are going to come from. I just don't. I can't say to myself, I'm putting on a short position for a huge break. You know, sometimes I see these fabulous looking momentum divergences like I showed you on the IBM weekly chart, right? And I put the trade on and it just gives us a little bit. What was that one stock that we did the daily buy divergence on, and it looked so good, and it turned rig or something. It was like some stupid shot. It had like this beautiful weeklies and beautiful dailies. This was like months ago, and it just kind of gave a little bit. It didn't do a whole lot. And then other ones, it's like, wow, it comes to life, and it was just a really great trade. So you don't know where the thing's going to come from. You must update it one date at a point. You can't try to hit home runs, say, this is it. This is the big swing short. I mean, you know, big picture, in my opinion, with the markets now, I don't see, I see that we got overbought. You know, I see that the weekly, if you look at the weekly oscillators and structure, they're correcting down. You know, there's a lot of sloppy stocks out there that have broken down, but we still have stocks making all-time new highs. So there's a lot of rotation, which can obscure the cloud. Some sentiment indicators hit an extreme. Others, you know, they're pretty neutral. They haven't reached the levels where I'd be like, oh my God, mortgage the house. You know, it's time to put a big short. And same thing with the monetary conditions. My monetary indicators are actually still quite favorable in terms of liquidity out there. So, you know, we might get some good swinging play after this huge markup that we've had. That's what we did. We had a huge markup, and we might get some rotation. So I never know for sure. I never know for sure. But if I'm looking for a bigger type of trade, then I still approach it the same way. Here is my structure on the weekly charts. It's a descending wedge. I like the 3 pushes. I like the technical chart formation. I love chart formations where I can draw, you know, see that the volatility is collapsing. And then you put the trade on the breakout. And anytime you have a rising or falling wedge, that's one of the trades that you can trail a stop on. Sometimes the market, and then it's a percentage game. You see, you have to look at these things as a numbers game. 3 out of every 10 trades are going to be huge wins, and the rest will be disappointments or fizzle. 30 out of every 100 trades will be, you know, decent wins. You know, 300 out of every 1,000 trades, or maybe it's just 50 out of every 1,000 trades are going to be huge home runs, but you can't see in advance where they're going to come from. So you just keep playing the game, just like you're dealt another hand of poker, you're dealt another hand, you know, you're playing a game of bridge, you're playing a game of cards, and you just never quite know where the opening is going to come from. So let's see here. Let's see here. Okay. Any last questions here? I sure appreciate your guys' comments. I mean, it's really a pleasure for me to share things I know with you, and perhaps like shorten your learning curve or just call BS on some of the stuff I see out there. We will make a recording available to all of you. Is there more opportunity on the yen? Take it one swing at a time. Again, follow whatever time frame you're trading there until you see a recognizable pattern. You're missing the whole point. Stick to your time frame. Wait for that one foundation trade. Don't get trapped up into trying to project where are we going to be a week from now. How are you going to trade that yen tomorrow? Where's the highs and lows to trade against tomorrow? You know, that's the point about understanding the daily candles and the 2-period rate of change and so forth. What is the process that gets you to exit your trade considering you are profitable? And that's probably the best question out there so far. How do you know when to exit a trade? And the first thing is, you don't ever have as strong of an indication to exit as you do to enter, okay? Because if that were the case, we'd just be stopping and reversing all the time. So we don't always know exactly where to exit. We can see levels. For example, today in the marketplace, we went up to that pocket level. We can look at volume nodes, previous trading ranges. If it's a test of a higher low, these are pretty key levels. That was the point of marking those horizontal levels in the first place, so that you could see this is a good place to at least scale out or take partials or tighten the stop, whatever it might be. It's an active trade management process. So you never know exactly, but we can see with certain patterns, this pattern demands trailing a stop. I don't want to exit too soon and cut off my nose to spite my face, all right? But those patterns are rare that you get that type of play where it's a trail stop. Most of the time, you scale out, take half off, and then see if you can get better on the balance is the best advice that I can give. And how do I count for news like political issues, impeachment? I don't. I ignore every bit of news because it just changes from year to year. I mean, did it matter when Clinton was getting impeached or this or that? No, it didn't ever matter. In fact, I think after he got, the stuff out of the way, the market proceeded to rally another 6% or something silly. Why not trade like a squirrel? Lots of little profits and some little losses, and I'll tell you exactly why. Because I guarantee you're not just going to be taking little losses. I mean, you think about it, you can say, okay, I'm either putting in a 6-tick profit and a 6-tick stop, okay? You better be winning at least 80% of the time if you expect to make money doing that. And you start to have slippage or news or noise. It's the noise that's going to stop you out more frequently than you think. And you guys are missing the whole points about being in the markets. Okay, the markets provide us with this insane opportunity. It's just that it doesn't happen as often as you think. It's if you were in the pit and you were good at scalping, you could get away with that type of game, just little nickel and dime profits. But you're always going to be a peon. You're always going to be, as my husband called them when he was my S&P broker down there, you're going to be a pea shooter. You're just going to be a little nickel and dimer. And that is okay for starting out. Don't get me wrong. You have to do that so you get used to execution, so that you've got the good habits, that you've got your stops and money managements, and you're feeling comfortable taking profits, and it becomes all automatic. There's nothing wrong with that, all right? Maybe you're going to eke out a small living, but you're not going to be making 7 digits a year doing that, I promise you. It's just not going to happen. Okay, you do your homework at night. I wake up the next day and all the trades happened overnight. I know, that sucks, doesn't it? Hey, that happens to me too, right? Not all of them though, not 100% of them. And that's the whole point about then looking at how do we open up the next day. And that's where I could go on and do a whole week teaching on Taylor, because Taylor would say, you come in, we've had 2 days high to low. We're looking for a buy day, all right? We're looking for where the market open, we test the previous day's low, and then we rally. It should be so simple, right? But what happens? What happens is the move happens overnight. We gap up. So now you've got buy day, high made first, the market opens up. Let's see if we trade back down into that gap area, even if it's just by 4 points. And if we can then make a higher low, then Taylor would say you have to wait to buy the higher low. You can't chase it. So it's working with the market a little bit. And I promise, if you wrote down every night what you thought you should do the next day, you'll still be right the majority of the time, okay? If it's the first day low to high, there will be an opportunity for you to buy a higher low, even if it gaps up higher. And it's not that tragic. It's not like everything happens in Europe, or else I'd be living over in Europe and not in the US. What ATR function do I use on the breakout, the trade sheet? If I'm looking at a 2-day look back period, I think we used 80 to 85%. If you're using a 1-day look back period, I think we use 90 or 95%. It just simply depends on the trade frequency, and you can model all this stuff. I haven't updated the modeling on that for about 7 or 8 years. It could have changed. And what might be optimal one quarter could be totally different optimal for the next quarter. You could do all kinds of permutations on that, and TradeStation has a wonderful way to optimize stuff. So pockets, once again, go back and just study when you're in a channeling market. It's the little dips that provide the support. It's providing a higher low, if you will. For trading platforms, I use several. I use the Photon Trader for my execution on the futures. It's probably the fastest thing out there for me. It only does futures though, understand that. And it's got kind of a marginal charting information package. So I like having TradeStation or CQG for the charts. And Photon has these gorgeous little equivolume candles. If you looked at my husband's Twitter feed, Damon Pavlatos, you'll see numerous examples of the equivolume bars. In fact, it's, I think, the best program out there that has that. And it also has a market profile module. But it's limited in other things. It doesn't have like data going back so far, and it's limited in many areas. So I use the Photon platform for the futures. I use Interactive Brokers for stocks and options, and also the Boons. What was a thing that was a game changer for me that I feel that I learned? Really understanding trend days and the volatility breakout system, how the power of range expansion and what a real trend day feels like. That was a real game changer for me. And I put that in my Trading Sardines book about how Bob Duran's volatility breakout system really opened that door for me, because I was in the pits. And so you're always being counter trend to the money flows. And this gave me a tool where now I could understand what it felt like to be on board a trend day, even though you might only get 1 or 2 great trend days a year. Is there any course you are going to teach? I'm thinking about some format for a special 1-week workshop. Mandy and I did one together last year that was 2 weeks. I'm thinking maybe like doing a 1-week thing and then like 4 weeks support or follow-up. We're still trying to kick around ideas that would be most beneficial to people at an affordable rate, but yet still not do too much interference with my trading. Because that's always an issue. You know, I can talk and teach all day long, and it's hard for me to trade too. So, and the other thing is that my husband's been doing a sort of a live during the day type of format with a market profile, just the first hour and the last hour. So we're thinking about coming up of some way where he could do around the opening, because that's always a hard time for me. I can't talk, you know, or concentrate and, you know, do 2 things at once. You know, but I'm very good pre-market. I'm very good at, you know, doing my homework at night and sharing that. And I'm very good at posting chart examples of trades on a minute basis during the day. So we're trying to work with some formats and see if that would be like a little community trading room or a trade idea room, because, you know, that's the key, is always having pairs of eyes to help spot these potential trade setups and so forth. But when I do, if we do come out with something, I promise I'll send an email out. But you know, I'm not here to sell you on anything or go that route. That's not my purpose. Let's see, the bonds. Are there any other nuances to stand out about the bonds? A favorite setup. You know, bonds are really interesting because they don't have quite the play that the indices do. And I'll be totally truthful with you. I have a love-hate relationship with the bonds. They were absolutely my best performing market for 2 years when I had the fund. And then after the 2008 implosion in 2009, and with the advent of quantitative easing, a lot of my models just stopped working. You know, the 5 SMA stuff stopped working, the pinballs stopped working, a lot of things stopped working. So I went through a little period of kind of getting beaten up there for 6 months while I had to adjust and change my thinking. You know, you make enough bad trades and the market forces you to change your thinking. So I did, and I'm still pretty respectful of that market. I love positioning in the bonds for a 1 to 2 day trade. That's really where my strength is in the bonds, is putting on the trade, holding it overnight, and then exiting the next day. I did that just 2 days ago. There was a nice little pattern that I put of this higher low on the, I think I tweeted it out, the 30-year yield chart. You know, I love that pattern, and I just got really lucky. I sold the bonds at night, and came in, and lo and behold, I don't know, the boons were down a full point and the bonds were down, and it was kind of a gift. And I think I held them one day and I covered them that next night. So the bonds are interesting. I'm glad to see other people looking at them. Let me just see here. Have I ever been interested in trading small cap or penny stocks? No, that's not my game. I never will be. You know, I just, like when I had the fund, I had to have trading vehicles where I could do size, you know, because you're not going to be trading $140 million on penny stocks, you know, and it's just, it's not my game. I just never has been, and I've never even looked at that stuff. I don't even know what the symbols are. I keep my database to like 300 or 400 big cap stocks where I can do options. You know, you've got like weekly options. Why not trade stuff like that if you're like hot to trot on some of these? But I know there's been some crazy moves, especially in some of these pharmaceutical and weirdo stuffs, you know, pot stocks. Goodness knows. Oh my goodness gracious. Do I enter on the indices, buying or selling, ready for the opening? And of course I do. I'm looking at the DAX and I love the patterns. I'm always at my desk at 7 a.m. Central Time, 8 o'clock Eastern Time, and sometimes I'm even sickly here earlier. I'll come down and look at the markets for an hour, and then I go to the gym on certain days and I come back. Yeah, I love, I haven't seen any great ones lately, but sometimes there's these really gorgeous little 15 or 5-minute bull flags that form in the DAX, and I'll trade that on the S&Ps, and it works, you know, it works majority of the time. I don't trade the cryptocurrencies. I never have. I've just got enough other liquid markets that are well behaved and mature that offer plenty of opportunity. And you know, I saw a quote from Stanley Druckenmiller that was like on Bitcoin, and it was like, well, it's worth what everybody thinks it's worth. You know, I mean, it's a market out there trading. I don't know, you know, what it has intrinsic value or not. It's just not my game. Okay, I'll leave it at that. There's far better ways to get into trouble out there than cryptocurrencies. Do I have all my, let's see, is missing half the opportunities trading mostly one direction only, shorting 90% of my positions? You know what, you're talking about having a bias, and everybody has a bias. I mean, I had a bias for 10 years where I could only trade the S&Ps to the long side, and then the following 10 years I could only trade them to the short side. There's nothing wrong if you have a bias. Just recognize that you have a bias, and maybe you want to use a different vehicle, you know, for the other side. I mean, there's nothing wrong if you like trading the S&Ps from the short side. Perhaps you might look at the NASDAQ from the long side, or vice versa. You know, some of these things are, you know, we're human. So I've seen people who only like to trade from the short side and only like to trade from the long side. They just don't fight the market. They stand aside when it's not favoring their style. So you have to look and see what works for you, and there's no right or wrong. You're right. You know, that's the point of keeping statistics. Your bottom line will tell you. And if your bottom line is in the red, you know, for a couple weeks in a row, look and see what you're doing wrong and adjust it. And if you can only trade a market from the long or short side, stand aside when that market's doing funky things. I had a very difficult time trading the bonds from the long side. I always joke about it with my colleagues. I can capture 90% of the move, you know, from the short side, and on the long side, I'll capture like 4 ticks, right? And then it'll run 2 handles. So that's just me. Okay. Which settings work better for 2-period rate of change, at the bar close or at the price change? I just use the close of the US session, and I've tried it like using it at noontime. It doesn't really matter. It's really interesting. That's an interesting exercise, you know. Just take the same data point, you know, at the same time of day every day, and use that for your reading. You could use it like 2 o'clock reading or 3 o'clock reading. You can do these things on TradeStation, you know, program the session hours. Do I have position sizing strategy, fixed fractional? You see, you guys, I promised I'll be here till midnight answering your questions if you're sticking around. My position sizing, I have explained this in previous webinars. I don't do fixed fractional. I set my unit size at the beginning of each month, if that's the mode that I'm in, and I adjust it to the average dollar range. So as the volatility expands, I might be doing fewer contracts per X number of dollars in my account. You know, if corn is having a 6-cent range, I'll trade much bigger size. If corn is having a 30-cent range, you know, I adjust my position sizing for the dollar range per day, and I do that with all the markets. As a statistics person that studied the open balance, what do you think about the opening range breakout as a way of trading? A lot of people are doing that. I mean, there's an edge there. You know, you need to model it and find your own parameters and test that. I mean, ever since Toby Crabell put that out there many, many, many years ago, that's why you see this goosing and this open drive and these money flows. So you just need to be very confident in, you know, when it doesn't work, how you're going to manage that trade when it doesn't work, when you're in a noisier environment, and understand that what you're doing is you're capturing a tail, and it's going to be a smaller percentage of the time. So it's a valid statistical way of trading, and it can be noisy and choppy at times and very annoying, but there's an edge there for sure. For sure. I read Taylor's book and I don't understand a thing. Yeah, me too. I'm still reading it after 30 years. I don't understand half of it either. You know, I have to take a yellow highlighter and understand the very select few sentences that do make sense to me. But I will do a seminar or webinar one of these days. I'm sure I've done them in the past. I've got a YouTube channel with like 70 videos on there. I'm sure there's got to be one on Taylor. Taylor is all about that price action around the previous day's highs and lows, capturing the trend for the day. You know, that's what Taylor's about. Forget looking at his book, how he makes up his book. He didn't have charts in those days. They didn't have computers and charts. So it was his way of kind of trying to keep track of measured moves, you know, the percentage of retracements. He's looking at things like that. He also was, if you study Taylor, he's looking at the seasonals. In the back of his book, he had positions on. He was a grain trader. He had positions on, just like Gann. Gann's really looking at seasonals too, his anniversary dates and things like that. All these old timers, they're very well aware of the seasonal tendencies in the markets, as was Taylor. Same thing when he's looking at the breakout from a range. He's not trying to fade it, you know, do the sell short day. He says, let it run 5 days, okay? So when you get a breakout from a range, as you would a clump on a point and figure chart, or the charts breaking out of the balance area that you would perceive on a market profile type of thing, you let it run for a little bit, you know, and it could fail as well. Ash and Hole moving average and tick charts and Heiken Ashi, I don't think anything of them because I'm strictly KISS, keep it simple, and I can't even pronounce those words. So oh, I'm so glad to see people actually have the photon trader. I'm really glad because, you know, honestly, Jesus, you know, my husband doesn't advertise it at all, you know, and I've been using the dang thing like since 2000, and you know, no advertising or anything, and it's, I think, the best hidden secret out there. I don't know why, you know, it's just hard to compete out there when you've got the trade stations and all these other things that have all these gorgeous charting packages, which are totally valid, but there's nothing better for execution out there and being stable and zero latency than that photon trader. How long do models last? It depends on the size that you're trading on it. The bigger the size you trade on it, the greater the odds that it's not going to last very long. That's Murphy's Law. So, you know, the more variables that you put in a model, the less robust it gets. So most of my models have 2 variables only, and they tend to be extremely durable and robust. The same stuff that worked 40 years ago and 30 years ago tends to work now, and that's why they're models, not mechanical systems. Okay, just suffice to say, when you have those 3-bar consolidations, look at that on a like a 120-minute chart, okay? Just look at a 120 to 40-minute chart and start to see the price bar overlap that goes through there. That's what's formed your balance area. And now imagine the train leaving the station, okay? And whether you want to use an average true range function to try and get on board, or you want to look at the US session opening and a short-term continuation pattern to get on board, there's lots of ways that you can do that. It's not easy because everybody sees the same thing, so you get these markets that move very urgently, and that's the trick. That's why volatility breakout things are helpful. At least they give you some pivot point. Here's somebody. Damon's levels are scary accurate. He just walked into the office. He's my husband. So thank you, Billy, for your comments. Why not do a pre-market and night? It would be, yes. Why not do a pre-market and night? That would be helpful. Okay, so we're getting our program for next year. We're going to do our homework at night. I do that anyway for myself. That is not a big deal. I can share that with you, okay? And we can do a pre-market. I'll do the pre-market because I'm always sitting down at 7 a.m. and looking at how the market's traded overnight. That's easy for me to spew out stuff in the first half hour, and then I'll pass the ball over to Damon. You ready? Catch, okay? So and then I'll post charts during the day and talk at lunch, maybe something like that. You guys are the best. You guys are the best. Do I use stops on naked options? No, I don't sell naked options, or else I'll end up naked and not being able to afford clothes. That happened to me once. It only takes once. Fortunately, I had a few rags I could wear for 5 years. Are levels more important than indicators? That is a great question. And at what price at the level are you interested when you're placing a trade if the indicators are not there? By indicators, you're talking about looking at momentum oscillators, I would assume, okay? So the times that the indicators are not there is when you're in that bracketing market where we are starting to form a trading range and we get that test reject. And at those points, as you are probably aware, indicators such as a short-term momentum oscillator is not going to serve you, or the 310 thing on hourly charts or so forth. You need to be a visual person and see the levels. If you wanted to go down to like a 1-minute chart, I'm sure you will see a teeny higher low on a 1-minute chart or something. There's always a way that you can figure out to get in that way, but let the levels come first, okay? You want to have the level and the indicator that helps you initiate or get your confidence. That's the perfect world. Do you know your exit before you make your entry? I don't. I would like to see it go to a certain level. I would like to see us go to that gap fill. I don't know if we're going to fill the gap completely or just partially. So it's like once the market gets to a general area, then I'm starting to target it. Sometimes it just fizzles out. I'm like all you guys, I mean, I give it enough, we get out of partial, take the whole thing off, and then boom, then it moves. That's just part of the game. So I try not to see, I see a level that I want to play for, if that makes sense, but it doesn't mean that we get there, and sometimes we can blast right through it. Is 10 points in the NASDAQ considered a scalp, or what is a scalp? That is a great question too. A scalp to me is anything that is just one swing, okay? So if you make a trade on a 15-minute chart and you're just capturing that one swing, that's a scalp. If I'm trading off of a 60-minute chart and I'm just capturing a piece of that 60-minute swing, that's a scalp to me. It's sort of like a day trade. It doesn't mean that I have to have a holding period of 2 minutes, and it doesn't mean that I only have to play for 4 ticks. I mean, I just consider it to be a day trade, and hopefully a scalp will turn into a bigger, holding for a longer period of time. But sometimes those ones that don't quite do what you think they're going to do turn out to be scalps at best, and scratches and little nicks at worst. So there we go. Do I trade the Russell? I do. I have a love-hate relationship with that too. I trade the indices, the currencies, the metals, the energies, the softs, just coffee and sugar occasionally, and the grains and the meats and the boons. And I don't trade all those at once. They're just my little stable. I might only trade 3 or 4 of them one day. It kind of depends on what's setting up. I haven't made a trade in hogs for a long time, and I haven't made a trade in, I don't know, a couple markets for a while, but that's okay. Let's see here. Do I manage a hedge fund? I did for many, many years, and I'm retired. Can't you tell? I'm retired. This is what I do for fun in my spare time. Interact with other traders. Okay. The 310 oscillator is just the difference between a 3-period and 10-period simple moving average. And yes, you can use anything you want. You can use a stochastic, you can use an RSI. They're all derivatives of price. So pick your poison, that's how I say. And I don't look at percent risk. I am more inclined to just use a fixed dollar amount. I don't want to risk more than X dollars per trade. That's what works for me. There's not an optimal fixed stop size because it's going to depend on the market's volatility at the time, and what might be appropriate, you know, in one type of environment will be completely inappropriate in a different type of environment. So I love this. Opening range breakout is a psyche killer without structure. You get chopped to hell and then you miss the big one. You know, it's like everybody has their specialty, right? I mean, I can't slam it if somebody's doing it and it's working for them with their bottom line, right? It's different things work for different people. Why on some of my charts with the 310 indicator have dotted sections on the slow line? You know, so here's another little weird thing. Sometimes I change it up. Sometimes I like looking at charts with the stochastic. Sometimes I have a page and it's got a white background. Sometimes I have a page and it's got a black background, but it's got the same damn charts on it and the same damn time frames. But you know, it kind of keeps me fresh. You know, I'm coming in and sometimes I sit down and it's like, oh, that white background's just too white. You know, it's too bright. I got to go back to the black background. So that's just me, right? Everybody creates. You guys got to understand, you create your own playing field. You create your own game board. You create your own little universe. You're creating your own religion. And I'm sharing with you my religion and my game board and my universe. Bits and pieces of it might work for you and bits and pieces might not. The whole important thing is that you're an independent thinker and you come up with your own thing. You know, how you execute. I've gotten very bad lately about entering more orders at market than I should. I think I've been giving up too much, but I've got an assistant who's fabulous with my execution. So now I'm like, okay, try working the bid first, you know. Kyle, so he'll work the bid first and it's like, we don't get it in a minute. I'm like, okay, payoff, you know. So do I cross the spread on options trade? No, I don't. Okay, if a trade does not go in my favor immediately, do I exit it? Not necessarily. It just depends on the time frame that you're looking at. For example, if I'm looking at a 60-minute chart or a beautiful bull flag on the 240-minute, I guarantee it's not going to go in my favor immediately. It might even chop around or go against me just a little bit. I honestly can't answer for the Thinkorswim platform. At one point, my husband Damon was the managing director over there in the futures market, and so he got his hands on that Thinkorswim platform, and he was the one that created the original monkey bars, you know, the market profile stuff, and we created some stuff for them. And from what I understand, I think they've changed some of the market profile stuff, or paint bars or whatever. I will say this, you guys, TradeStation has to be the best value out there. I'm not suggesting that you have to use it for your execution, but the platform's basically free. I think you pay like $15 for your data feed, and you open up a small account, and I mean, you can't really, it's just like Thinkorswim, you know, but it's, I think, got lovely charting features and can do so much more. The radar scan now that is free. It's incredible. Where's my dog? I think my dog's in the backyard now. I got two of them. They feed off of each other. One day at a time. Some of the swings trades take 3 to 7 days to unfold. How do we look at the market for swing trades that last for a few days? Okay. If you're newer to the game, don't look for that. Start off small. If you're going to look at a longer time horizon, you probably want to be working off of the daily chart. So for example, with my daily 310 buy divergence that I showed you, I actually showed you a weekly IBM example. I mean, my holding time for that trade tends to be about 4 days. It takes about 4 days for it to get to the moving average on balance, okay? And sometimes it blasts through it and gives me a lot more. After 4 days, I'm pretty much looking to take part of that trade off if I've got options on. And honestly, I just don't get that opportunity nearly as much. I think I posted a trade, when was it? It was about 2 weeks ago, and I think I posted it on Twitter, and it was KLAC. Clack Corporation. So KLAC had this really textbook sell divergence at the top with the 310 oscillator. You can go and study that and see what that looked like on the 310. And I mean, it was just one of those trades where it was perfect. It gave a little rejection tail up there. The 310 oscillator was perfect. And I was thinking, oh, this has to go down to the moving average on that daily chart. And instead, it definitely found a hole through the pocket, and it totally fell out of bed. So like 1 out of every X number of trades will be that way. But that was an example on the daily chart. You know, they don't all work out like that. But if I'm going to be holding for longer than, you know, a couple days, I want to see some type of formation on the daily chart. Who is a better overall trader, you or Damon? That's a weird question. Damon's been running a technology company. You know, he's been running his software company. He's a fabulous at the markets. You know, if you've been so privileged as to hear him during the first hour and last hour of his day, he's brilliant with his levels and market profile. But you know, there's a lot of moving parts when you're running a technology company, which is that software, the Photon software, and the connectivity with all the different FCMs and the backend operations. The platform's actually written in Chinese, and you know, can connect to the Singapore exchange and all these different things. So you know, I could be a horrible trader one month. I mean, I could just have been poor health or out of sync or like zigging when I could zag, you know. I mean, every trader out there goes through horrible periods, you know, or I could be on fire and totally in groove or in sync with the market, you know. It's not how do you compare yourself to somebody else, okay? That's not the point. How do you compare yourself to yourself? So my bowling scores, man, you don't want to see my bowling scores, you know, you don't want to see my golf scores, but I feel like a genius if I, you know, did better than the previous time. And that's how you want to see yourself in the markets, okay? It's not like who makes more money. It's like, are you making fewer unforced errors? Are you making better choices on your trade selection? Are you displaying good preparation for the night before? And just like you know, having a bad diet, you know, you can fall off the wagon and eat chocolate cake 7 days in a row, but that's not how you want to live your life. Then you get back on board, get back into your game plan. Maybe you need to take a few days off. Maybe, you know, you fell off the wagon and stopped doing your homework because you're burned out. There's nothing wrong with that, you know. Take some days off and then get back into your groove and be the best trader that you can be. Thinkorswim is a great options platform. You're right. I would use Thinkorswim before I used TradeStation for options, but they all have, every platform has its strengths, you know, so understand that. It's not like there's one that's better than the other. They all have things that they can do exceptionally well, and then things that you might want to look at other platforms for other things. Okay, for the anti-pattern, is there a precondition before the impulse move that we need to look for? No, the whole point is that the market's tipped its hand. It gives you that big impulse bar. It gives you that big range bar. And then it's the consolidation, and then the C leg. There was Rotella. What's his name? Rotella. No, Tony Plummer. Tony Plummer also wrote a book that he did a revision with like 20 years ago. Tony Plummer, Forecasting in the Financial Markets. And he explained the dynamics between this price pulse, as he called it. So if you are a true technical aficionado, or you want to improve your understanding in the markets, research Tony Plummer's book. I'm sure you can find it out there, probably a used copy on Amazon for a few dollars. I buy a lot of books off Amazon that are used, or else my book bill would be in the thousands of dollars. So look for Tony Plummer and read about that price pulse, because he does a good job of explaining the psychology behind that as the market has to digest the new information. KLA2 is a buyout target. Well, you'll always know after the fact what happened, right? But if you look at the technicals, they were there. Okay. Did the move from singles for a tick to larger size and moves come quickly, or was this a slow, gradual process? I'm up to singles for 3 ticks, but it's working. Yay! That's all that counts. See, you got to find something positive. Look at the stuff that's doing right. You got a confidence factor going there. That's okay. It happens in its own time. Just trust that you got something that's working, and it's building your confidence. And don't force it. It'll happen at its own time. And it does happen. It will happen. I can remember when I was trading for my fund, and my fund was getting bigger, and I went from, my mouse clicks, I went from doing a unit size of 100 contracts to 300 contracts. And the first time I did it, I've been trading for like many years, I don't know, 25 years. I almost had a heart attack, because all of a sudden I'm buying or selling 300 at a time, and I was having an adrenaline rush. I don't think I could do that size anymore, quite honestly. I mean, it's that was a fund. It's not my personal account. So I've dialed things down a lot. What is the market doing over the next 20 days? Driving you guys crazy, because you're going to be looking for all these patterns now. That's what we're doing. And to hear Damon's talks, he did post his last webinar on the market profile. Is it on your website? Which website is it on?
DamonPablatos.com.
If you go to DamonPablatos.com, he's got his last website on market profile. Hey, Jeremy, shout out to Jeremy. Glad to say hi. Glad that you're looking at the markets here. You will rewatch this webinar. It is being recorded. We will post it. And do I still trade 80-20 in turtle soup? I'm always aware of that turtle soup, because it's the tests around those highs and lows. Remember those first charts that we looked at with the wheat and the S&Ps, and it was showing the tests on those 20-day highs or lows. That's the whole point of the turtle soup. It's just a funny little name for the tests of the 20-day highs and lows. And yeah, there's always good opportunity around there. Same thing with the 80-20 bars. I mean, there's the principles are at work there. They really haven't changed. So there's lots of tools we use. Oh, I'm so glad somebody is on board with Tony Plummer. Excellent reading, explains crowd behavior. Yes, see, and you can see how that price pulse gets at work. Sometimes, we get so caught up in the technicals, it's hard to find somebody great to explain the psychology behind it. Damon's really good at explaining this auction theory, crowd psychology behind that. But Tony Plummer did a really good job on that price pulse thing. I like the S&P tick charts for the overnight action, and I love the time charts, the 30, 60, 120 on on the higher time frame. What percent of my portfolio do I use on one idea or trade? I don't really break it down like that. You know, I used to have different programs or plans. I still do, but it's not like I necessarily allocate a certain percentage of my capital that way. Can I recommend any resources for better understanding volume profile auction market theory? Well, my husband Damon, number one, go and see his webinar that he posted on the website, and you can also find. I like Jim Dalton's first book, Mind Over Market. You know, that test reject concept. I thought he explained really well. And I bet you if you just Google on the internet, you'll find tons of stuff. Do I use market profile in my trading? I personally don't, because I'm so used to the bar charts, but I sometimes look at the volume distribution, and it's near identical to the markets, to the profile concepts. I do. I love looking at the market profile. I think it has a lot of value. I like it for making the levels, but I find that I personally do best just marking them off on the 240-minute candle charts. See, there's a million ways to skin a cat. And here's another little secret. Sometimes when you look at these volume distributions and you see that fat volume node, you know, that big fat profile node, that's also right at the level that the moving average is going to fall. You know, if it's the 5 SMA or the moving average on a 120 or 240-minute chart, it's going to be the same as a volume node. It just works that way because that's where there was a lot of trading. It's kind of a reversion to the mean type of principle. How do you know if your edge suddenly stopped working? Well, your bottom line would tell you. That's why we keep statistics. That's why I had an edge in the bonds with my 5 SMA and some of these patterns and systems, and they imploded after 2008 with the advent and the startup of QE. And, you know, after like 3 or 4 or 5 bad trades and bad experiences and stop outs, I'm like, you know, I need to stop doing this. Something's changed. So you can look and see what has changed. Has your market environment changed? Has something changed with you? Are you looking at different technicals? Did you curve fit something? So lots of variations. Heads up, we've got 12 minutes left on our Zoom session. Oh man, you guys are the best for stay. Okay. What is my best setup model currently on the S&Ps? You know, it's just stay in the moment. Follow the 5, 15, 30-minute swings. Look and see if there's confirmation, non-confirmation with the NASDAQ. I love that game. You know, it's an organic, holistic type of market, you know, so it's not like there's one linear setup. You see what you're doing? You're looking for a particular linear setup. I already gave you one, like that 5-minute ante or that 5-minute buy divergence. Those are stellar trades, but the frequency of occurrence might not be very, very satisfying to you. You're not going to get like 3 of those trades a day. You might get like 3 a week. So go back to what I said. That's about as linear as I can get for you for looking for a specific kind of rule set play on the S&Ps. But of course, there's different stuff that happens every day. I look at the ticks and the VIX and lots of stuff. Kyle, did Linda answer my question from earlier and I just missed it? I am so sorry. Ask it one more time, Josephine, if there is still time. What do you think of drawing charts by hand? I know it's done by all-timers. Fabulous exercise. You'll learn a lot. You'll probably stop doing it after a few days because it's very tedious, but you'll still learn a lot. Okay. What can I say about Elliott Wave? It's a great way of telling you where you've been. And that's why every Elliott Wave person I know will have several alternate counts and they never agree with each other. I cannot do any statistical modeling on it. So it may help you find a roadmap, or it may not. It doesn't work for me. For the 2-period ROC 30-day high, it means, yes, a look back period of 30 data points. Okay, so just the trading days. And you know, you can play with these things. Model it with the 20-day look back period. Model it with the 25-day look back period. I haven't updated these things for a couple of years. Take it and make it your own, okay? And see the times that it doesn't work. That's equally important. Always analyze these things for when it doesn't work. Where do you place my money that is not in trading? Okay. Cash. I hate to say it, but you know, like Interactive Brokers gives you, I think it's down to like 1 3/4% on your idle balances. There are, what is it? Marcus, I think, is an online bank account, a banking thing. I think it's a Goldman Sachs thing, and I think they'll give you a fixed amount, like 1 3/4, but it's not an annuity. It's not a CD or anything like that. So you can get 1 3/4% right now on idle balances in basically a bank account. Do I believe in taking every occurrence of a setup, regardless of context? No, context is very important. Why would I want to take a setup if it's a stupid, light volume, noisy market, you know, and it's just before pre-FOMC and everybody's sitting on the sidelines and there's no volume? I would be very, very careful. So yeah, experience helps put things into context. When prices stretched through the European-Asian session far away from the Globex session, is there an edge if we open just at the end of those stretched prices? I'll give you one last piece of information here. If you've trended strong in Asia and you've trended strong in Europe, odds are that the US morning session is going to be a consolidation or a rotation session. So you can think about that. Elliot Wade gives me a headache. Yeah, me too. Okay. How do you see first opportunity for a day trade? Oh my goodness. You want to look and see. For me, I want to look and see where the action is. So I'm looking to see on my board if there's which markets have the early volume and how the market traded overnight. There's not one fixed answer there. The 20-day highs and lows are not so significant. You could use a 30-period channel or a 10-period channel. All these things just help highlight the swing highs and swing lows. It doesn't have to be a 30-day look back period. Barcharts.com, you can go there, and that's where I get a lot of my sentiment indicators. It's great, great, great site with all kinds of stuff, including monetary data that helps give ideas on the liquidity variables. So sentiment, think about it this way. If everybody's bearish, if you see massive bearish readings in sentiment, the odds are that there's all this cash on the sidelines. And everybody's wildly bullish, the odds are that they're pretty much fully invested and there's not so much cash on the sidelines. So that's an oversimplification there. A significant change in the market. That is a topic for a novel. If you see a short opportunity on everything, but you go short too early and then you stay in a drawdown to your move. Okay. Triggers, guys, and stops. There's nothing wrong with trying several times. Paul Tudor Jones was a master of this, from what I understand, looking at turning points. He'd go in, get stopped out, go in, get stopped out. You have to have capital preservation first and foremost at the front of your mind, okay? Wait so the technicals line up, initiate with your trigger, and have a stop on the opposite side. And if you do that too many times, the market's telling you that you've got the main idea wrong and you've got a wrong bias there. So where is your edge? What is it that's making you so determined to be bullish or bearish, okay? And how did that turn out with previous examples in history? You know, what are the variables that all lined up? What is your model, okay? Think about these things. Okay. All right, I think our webinar is ending. Thank you all for joining me today, and put together your game plans and your business plans, okay? Start thinking about 2020, and we will make a recording available for you. Ciao for now. Happy trading tomorrow. And thank you, Kyle, for sticking around, and my husband.